Hello again, and welcome to a financial thought leadership podcast, Banking on Experience, sponsored by CRM Next, the banking CRM, where we simplify work, drive growth, and deliver on experience. This podcast is meant to empower individuals working in the financial industry with stories, experiences, and knowledge straight from the source. Please take a moment to rate, review, and subscribe on your favorite podcast platform, and stay tuned for an awesome show. Welcome to another episode of Banking on Experience. I'm your host, James Gilbert. We are joined today by Jonathon Taylor, who is the CEO of CU Soul. He has been working with credit unions since 2007. Today, we're going to be talking about a special topic, which I think every credit union should hear, and that's how to avoid mergers and acquisitions. Welcome to the show, JT.
Hey, thank you. I really appreciate you having me today. Thank you.
I always start the show off by asking a question that kind of gets thought-provoking. If you could do one thing that you think is going to change the world, what would it be?
If I had to pick one thing, it would be to do everything I can to support credit unions and leagues from disappearing, from merging. Honestly, that really is a massive passion of mine. Number one, and number two, as part of that, I would do everything I can to help folks in the movement not forget about where they came from, the why that they do what they do every single day, that history piece, which is also ties into why I hate to see credit unions merge, because they lose that. They lose that story, that history, that why. So those are two pieces that I'm very, very passionate about.
Love it, JT. Tell us a little bit about CU Soul.
Yeah, so CU Soul is a credit union owned CUSO, so a credit union service organization. And we have credit unions in 3 states, DC, New Mexico, and Guam, although I suppose it's a territory, not a state. So those 3 areas are where our owners reside now. And I am in Portland, Maine. So we are really kind of a 4-state CUSO with 3 different time zones that we're working at any one time. But the why behind us, it was formed between 2 credit unions, one in Albuquerque, New Mexico, and one in Guam. To, as my junior high soccer coach used to say, move to space. Don't go to where the ball is, go to where the ball is going to go, or where you think the ball is going to go. And so to offer unique products and services in the credit union space, and everybody says that, but we really mean it. Offer products and services that there aren't a lot of options for credit unions in, and with an asterisk and a bonus point towards scaling down to offer products and services to smaller and mid-sized credit unions as well, because we've seen a massive reduction in options for the small to mid-sized credit unions as well. So really serving the underserved from a product standpoint, but serving the underserved from a credit union option standpoint as well. And our new tagline is solutions with soul. So everything that we do has heart, and we lean forward with heart. So if we were one of the members of Captain Planet, we'd be heart, and if we were a Care Bear, we'd be heart. So that's our deal.
I mean, that's one of the reasons why we love working with you, JT, is because of that right there. Yeah. I think we need more leaders in this particular industry that care and are trying to drive action around it.
You know, I think there is a tremendous amount of heart in the movement. I just think that when you get to there's so much going on. There's so much noise in the space, in the movement, from regulatory and compliance concerns and the competition and fintech noise. And there's just so much, you know, for lack of a better term, and I can say this because I'm a card carrying member, but ADD in the movement now in the CU space, where there's just so much distraction. Yeah, obviously COVID was a massive, I don't want to say distraction, but was a massive piece that forced folks to focus in different areas. And what tends to get lost in the mix, in the noise, is the why and the heart piece. A lot of credit unions will, I find, in my opinion, talk out of both sides of their mouth, where, we're here for the members, but, they keep a lot of their money locked up for more of the special people, where they're the fees are getting more and more tempting, and where the options are being reduced over and over again. So, I think it's important to continue to remember the why behind what we're doing each and every day, and the fact that credit unions were formed to serve the underserved, and not just the A plus credit folks, and the folks that have lots of options. It's for the folks who don't have a lot of options. That's really, in my opinion, part of the why. So that's what I'm really passionate about. And at the end of the day, if we can offer products and services that help save credit unions and help their members in deeper, more meaningful ways, that's a mission accomplished as far as I'm concerned.
Totally agree. There was something that you had mentioned when we had talked before about mergers and acquisitions, and I want to bring it to light. I'd like for you to explain what you meant by this. Mergers of mercy versus mergers of strength.
Sure. And let me just start out by saying I am not a merge expert. My experience comes from working in the space, and maybe I should start there real quick. So I cut my teeth in the movement at the Maine Credit Union League Insurance Trust, which was an insurance trust formed by the Maine Credit Union League and the credit unions in Maine back in 1963. So we used to say that we were the first CUSO in America, because it was owned by the credit unions in Maine and the league. I say we, please forgive me. My heart is still there in a lot of ways. The reason why we were formed was because it was a massive lack of options in the movement. In the credit union space, there was one provider of credit, life, and disability, which at the time was CUNY Mutual. And that's not a dig on them. It's just, that's what it was back then. And as you can imagine, the jobs in the late 50s, early 60s in Maine were, we could say, on the riskier side. The lumber, the paper industry, the mills, there was just lots of high risk. And the disability program that was offered through the credit unions blew up. Essentially, the experience was too high. There were too many claims. And so the credit unions lost the ability to offer that product. So I was baptized into the movement with, essentially America's first CUSO. And the reason why it was created was because of a lack of options in the marketplace. And so my whole career has been, in that concept of, don't ever forget that there was only one option, and it wasn't good, not because they were bad, but because there are situations that can happen where that one option can go away. And in my career, I have seen many, many, many options that have come into the credit union space, and for a multitude of different reasons have disappeared. And what that creates is a vacuum in the marketplace, and a lack of options, an increase in pricing to credit unions, to their members. And really, it just makes it harder and harder for credit unions to survive, because the folks that are left can cherry pick who they want to do business with, and who ends up getting left behind are the credit unions that are under 500 million in assets. Well, here's the problem. 83% of the credit union space is under 500 million in assets. So many providers these days look at the credit union space as hunting, not farming. I think we've all seen a tremendous uptick in that over the last 20 years. I mean, just in Maine, when I started, there was about 120 credit unions, and now there are 50 in the state of Maine. And I know now there's I think about 5,000 and change credit unions left in America, and they're saying that number is probably going to get chopped in half. So there's a tremendous amount of merge activity. And what's really sad in those situations is that in many cases, the credit unions that merge in, they don't need to, if certain steps would have been taken within the couple of years prior to that merge decision. I didn't make up this term, and I don't mean to offend anybody by it, but there's the mercy merge, which is a credit union that is going under, or the regulatory entity, and whether it's NCUA or the state that regulates that credit union, says, okay, it's time. We need to merge you in. You've had time to fix these issues, whatever they are, and it's time to merge in. And then they will help with the facilitation of finding another credit union to essentially merge in that credit union, or save that credit union by merging them in. And that, up until the last 3 or 4 years, at least up in New England, that was when mergers would happen, that would be what would happen. Mergers are a tremendous amount of hard work. They're a tremendous amount of time, especially when it comes to the systems. I always joke that it's funny that, they're like, hey, we're merged, everything was approved in April. And I'm like, are you? And they're like, well, we still have, the core, but they're both with the same provider. So that should be easy. And then it's another year and a half. I mean, it's 2 years really for most folks. It's an all-encompassing thing. But the saddest part of it, no matter how hard credit unions try, for the most part, right? I'm speaking in generalities here. The history, the story of that credit union vanishes forever, and it may be a paragraph in a history on the merge in the surviving credit union. But that's what I mean by a mercy merge. And then there's merges of strength, where two credit unions that are healthy and really are not under distress or duress. It can be more than two, but typically it's two credit unions of strength that decide that, hey, with our powers combined, you talk about Captain Planet, right? With our powers combined, we can provide more options to our members. We can get essentially more buying power in the marketplace. So we have more options. And so we can do more to survive for the long haul. And while that makes a lot of sense, in a lot of cases, it's, again, you do lose identity in a lot of those situations as well. And it's interesting, there was a merge of strength that was up here in New England that I was very, very close with. Both credit unions, had worked with them for years and years, and both had incredibly strong cultures they'd worked very, very hard on. And it was really interesting to see, okay, how are these two ships going to come together, in which it was almost like a rock, paper, scissors competition, with each line of, okay, what sales culture are we going to go on? Are we going to go centralized or decentralized? And it just boom, 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 all the way down. And it was a lot of work. And I think it's been a few years now. And even still, there's still the growing pains, I think, of having those wonderful cultures that both had worked so hard to get, to take those two decks and kind of shuffle them together.
How often do you think credit unions that are being considered for a merge go to their league that they might be a part of, or go to a league and ask for help before they make that decision?
I can't answer that from experience. I don't know how many times they'll reach out. I do know that there's been some situations where their representatives will come in to advise. I do know that a lot of credit unions will reach out to their leagues from a support standpoint, a consulting, standpoint. Who do you know that can help us in this process? We're thinking about doing this. So I do know that happens. I don't know kind of what percentage that happens in, but it's a really, really big deal when something like this happens. And a lot of times it's aging boards, it's a CEO retiring. And, I can certainly think of one story where it was that the CEO had, just out of a passion for what they did for so long, they had served for so many years, but in hindsight, didn't delegate enough. And so when they were ready to retire, they just really hadn't done a good enough job of preparing everyone else at the credit union to be able to pick up the reins. There was so much up here that couldn't be, that they had not put down for others or trained others to prepare for. And so the board just did not have a confidence that they could keep going. And I actually spoke with that CEO recently, and they were regretful that they hadn't spent more time working on that. They were so focused on the day-to-day, and they weren't sure. They just didn't think that the retirement was as close as it was for them. So, hindsight being what it is, but that can happen a lot, or just the board doesn't have the confidence, or they don't have the energy anymore to keep things going, just based on what they're seeing from the outside looking in. So that certainly can happen, and those are sad stories, because again, a lot of these credit unions that are merging in have 80-year histories, 100-year histories, 60-year histories, where they've been a staple in their community for a long, long time, who have helped a lot of members where no one else would. So it's tough when you lose a lot of that. And no matter how hard I think a lot of credit unions try to keep that culture and keep that local feel, when there is a merge, it's hard to. It really is. Things change, and the membership feels it. And in a lot of cases, they move on.
One of the things that fascinates me about this industry is how much they sometimes try to avoid opportunities to grow because they're so fearful that it's going to come across the wrong way to their members. Like, naturally, there are vendors that serve this industry, and there's an ecosystem of vendors that can either help you grow or they can hinder your growth.
I think that has a lot to do with the problem, right? I mean, we talk about, starting with very little options and then really getting to a place where there were a lot of options. And when I talk about the vendor ecosystem, it's a lot of different products and services, whether it's insurance products, whether it's IT related, core, bond coverage, and then of course a lot of the fintech. That's been the one that's probably the most served, in the last 5 or 10 years. And for a long, long time, there was, just like the credit union space, there was this cottage industry of what I call boutique agencies that were all over the country, that were small, 10, 15, 20 person shops, maybe a little bit more, and that were dug in to the movement, dug in like ticks, and they had the personal relationships, and everybody knew them. And like the credit unions, for a lot of the same reasons, either they didn't have succession planning, or there was a fatigue or a lack of options for them to offer competing products in the space. There's a million different reasons, but they started to dwindle, or they would get offered to be bought out, and they would kind of jump on that and retire. And so there's been a massive consolidation in the agent market. There's kind of two schools of thought. You can be a marketplace expert with the freedom to not be beholden to any one carrier, any one product provider, and truly be a non-biased partner for your credit unions, but only focus on a few products, but you do those products amazingly well. And you've got competitive options, and that's what you do, and you do it right. And that's that boutique, tailored approach. Or you can be everything to everybody and be spread a mile wide and an inch deep. And we're seeing more and more and more consolidation in the marketplace for credit unions, where everybody tries to be the jack of all trades, but unfortunately the master of none. And it's really hard to be good at everything. And that's not a criticism of any one organization specifically, but once you get more than 10, 15, 20 products that you're offering, it's just impossible to be really good at all of them.
What do you think credit unions can do to ensure that there remains a free market for them?
Okay, so Winston Churchill once said that if you want to see into the future, you have to look into the past. And again, I go back to, in the beginning, there was only one. right? It's like the Highlander. Then there were all these options. There were all of these different insurance carriers for all kinds of different programs. Okay. I'm talking about bond coverage. I'm talking about credit life and disability. I'm talking about GAP. I'm talking about vehicle service contracts. I'm talking about a lot of different products, key products that the credit unions have had for a long, long time. There were a lot of options. I had an agent call me 2 weeks ago lamenting that they only had one option for GAP. And they said, who does it in the credit union space now? And I'm like, I can think of that many on one hand, four options. So what can credit unions do? Well, that is exactly why the main credit union league insurance trust was formed. And they were formed in the QSO model. That's what credit unions can do now. The QSO space, and I'm not just saying this for my own QSO, but just in general, the QSO space is exactly where the credit unions can, I don't want to say fight back, but they can stand up for themselves in every possible way they can think of. I mean, when I think about the providers that are out there doing a lot of these programs, and and my background, of course, is insurance, so I apply a lot of this to that world because that was what I did for so long. Those providers do what I would consider arguably a double dip, where they make money up front and they make money on the back. Why aren't credit unions double dipping? Legally, right? Why aren't they having their cake and eat it too? And I think they are in a lot of ways with leveraging the QSO space. But I think that there's so much more that can be done. That question is incredibly timely because I believe on International Credit Union Day, that was when NCUA passed the new expanded QSO powers,
Yep.
act, where now QSOs can lend like a credit union. Holy cow. That is huge. I never thought I would see an expansion of freedoms in this day and age, but here we are. We've got to leverage and we've got to work together. Collaboration is at the beating heart of this movement, and credit unions have the power to make themselves bigger by becoming part of QSOs. I have an owner who is 34 million in assets, 34 million. I have an owner that's 1.3 billion. And when it comes to a voice in the QSO, they have an equal voice. And when it comes to making sure that what we can offer our owners, we make sure that it works for both sizes. I love having a $34 million credit union in my QSO because it's such an incredible sounding board to have to make sure that we're focusing on both ends. But because of their participation through us, they can do that. I was working with a vendor partner the other day who normally would say, I'm sorry, we can't work with them, they're too small. And they said, well, wait a minute, what about the umbrella of the QSO? Can't we create something where that credit union with another larger size credit union under the QSO umbrella can do this program together? And they said, yeah, absolutely. We can sell that with the carrier. And that was a big part of what the function was of the main credit union league insurance trust, was to create that umbrella. I know it's like super cheesy, overused in the credit union space, but literally create that umbrella so that the big guys look at the little guys like medium guys. The carriers, the hunters out there now in the movement that are really looking to just cherry pick the above 500 million. We can aggregate folks together under the QSO model to make them bigger as an overall entity, and to create products and create services that don't exist, currently in the space. I mean, credit union owned insurance products. There's so much that can be done, and it doesn't take a lot. It just takes some good ideas and some collaboration from just a few credit unions to be able to put something together, and the market's ripe for it. So the good news about this on a broader base is that I think that the solution already exists for a lot of credit unions, but it takes collaboration, and it takes some creativity and some elbow grease. Roll up the sleeves and put some work in. I mean, at the main credit union insurance trust, we created a CUSO created vehicle service contract that shared 100% of the underwriting profit of the leftover money of the program. 100% of that leftover money went back to the credit union instead of being retained by the ivory towers of the insurance world, or the big insurance agencies that serve the credit union space. And I was a very unpopular man when I started bringing that product out to the US, because they didn't want the credit unions to see that Oz was just a man behind the curtain counting their money. They wanted the status quo. And the truth of the matter is that in certain circles, the credit unions are there's really no nice way to say this. They're kind of treated like second-class citizens. When a lot of the insurance carriers or a lot of the different providers came into the space, they looked around and they said, wow, these credit unions have no idea when it comes to insurance. And in other industries that they had worked in, the dealer space being one of them, those dealers had learned about insurance and understood where every single penny could be drained out of it and leveraged. And in a lot of cases, those same providers were working in the dealer space, giving those dealers every red cent that was available. Yeah, when they came to the credit union space, they said, wow, they don't know anything. So we're going to give them that much, and we're going to take that much. And everybody's sworn to secrecy. The problem with that is that it's other members' money, and that the credit union is sending them other members' money. And the credit union has a fiduciary responsibility, and their partners have a fiduciary responsibility for being transparent and honest about how that money is being spent. And if that money is not being used, it should go back to the credit union at 100%. So it's concepts like that with CUSOs coming together, credit unions coming together to just collaborate, educate themselves, and understand how to work smarter, not harder, that can really make a difference. So really long-winded spiel, but the solution for credit unions is CUSOs, the CUSO movement. I think the solution for credit unions is to work together, to double dip in, of course, legal ways, but double dip in the most, the best ways possible, because at the end of the day, they're spending other members' money, and they need to leverage it as best they can and have a bigger voice shouting together.
JT, we're at time, but I would like our listeners to know something a little bit about you before we jump off.
Sure.
First of all, give you a little sneak peek to all our listeners out there. JT and Stephanie Smith at the America's Credit Union Museum will be doing a series that we're going to be hosting on this podcast. We're not going to reveal the name yet, but give a little teaser out there. So JT will actually be a host of that podcast. We're excited about that initiative that you guys are going to be doing. But for the listeners, where can they reach you?
You can go to CU Soul, and Soul is spelled SOL.org. And we are in a full revamp of that website right now. So I apologize, but CUSoul.org, all my contact information is there, and you can reach out to us there. I'm also on LinkedIn, and just really excited to hear from folks out there and help in any way that we can.
Love it, JT. Thanks so much for joining us.